if you and I were to get very concise and clear, like we go a mile deep in this conversation around protection now, protection in the future, protection of the people in your life, protection of your money, and also how do we position people to take down the deal of a lifetime? Welcome to the second episode of the Legacy Engineers RX podcast. I'm David Zapata, one of your co-hosts, and I have the pleasure to be here with Mr. Paul McHale. Paul, how are you, brother?
I'm good. How's your week been, Dave?
Wonderful week. Busy, but happy to be here with you, having some of the best part of my week, good conversation and learning with you. So,
Yeah,
as you know,
been looking forward to it all day. I kind of waited to have a cocktail for this podcast, so I'm drinking the old standby. I see you got a nice glass over.
yeah.
What do you want to talk about tonight?
Well, you beat me to the cocktails part, but I was going to mention our tagline, which is courage, cash flow, and cocktails. And since we welcome each other here with a drink, I think we should start at the beginning. I think we should talk about, last episode we talked about our story and how we landed in this position of wanting to have these conversations. I think coverage being the first part of the tagline goes first for a reason. And I'd love to share our framework on how we think about this. I'll give you an initial thought to start the conversation. I was sitting at a big convention the other day, and the keynote speaker was talking about the three areas where there's more confusion for Americans to have clarity in decision making in their lives are the following three things.
Let me
Number
guess.
one, go ahead.
I'm gonna guess finances.
There you go. That's
I'm
number
gonna
three.
I'm gonna guess. I'm gonna guess like estate planning, right, or taxes, something in that. I mean, I guess that's a little bit combined with finances, but
Estate planning.
I
Yep, that
think
made the list.
okay. And then, I mean, it should be, but is insurance one of them?
Insurance was definitely one of that. Financial services. The second, the other two that was fascinating to me, medical decisions. There's no clarity.
Okay.
Try to ask the individual, and you know this,
Shit,
how a
as a
bill.
doctor, I probably should have guessed that.
Yeah, but it's
I think
impossible
my
for us,
colleagues are gonna be ashamed of me.
No,
Just cut that out.
it's probably that you're so close to it, but for most of us, it's really a riddle to figure out what a medical bill is, what codes are we properly charged for whatever. So that was actually number one, Paul, which is crazy.
I can
And
believe that.
the other one out of the three was real estate transactions. Real estate
Oh,
transactions. Really interesting, right?
yeah, but they are kind of they get a little confusing with by the time
Yeah.
you're done with all the paperwork of 500 pages of signatures.
Yeah. So I saw that and it brought, a lot of clarity to me because, I have a clear mental model for a lot of financial decisions I made. At least I've been constructing that model and I continue to be open to learn. But in the other two, it's definitely a more challenging conversation. So it put in my head, what if we came up with a simple model for people to classify at least the main variables on how to make these decisions and also quiet the noise that you hear everywhere around right or wrong, this is better than that, and allow people to maybe make this decision from a place of understanding. So,
Right, because every model out there, every financial tool, whether it be an insurance policy, a mutual fund, an investment, they're tools, right? And there's not a single tool that's best for everyone.
mhm.
So I agree with you that if you can create something simple, something that someone can fall back on when they're a little bit confused and kind of reprioritize, that'd be helpful as hell. Now, knowing your
Absolutely.
brain, you've thought this forward and even come up with kind of a framework, I'm guessing.
Yeah, to me, it's like simplicity is the ultimate, tool to really have clear, concise conversations with people. So I try to draw down this to the minimum, the basic principles. What are the first principles that allow me to make these decisions?
This is why I think you're a genius, my friend, because
Ah,
they always say true genius takes a very complex topic and makes it simple.
well, you're very kind, but I really think it's in my pursuit of like, how do I have better conversations with you, with people, right? Like, how am I valuable to people? And I do, like I've told you before, I've spent a lot of time thinking about this, pursuing that simplicity. So I'll tell you, the first thing here is what you said earlier is I think we need to say to each other, especially when we work with clients, with families, with business owners. I tell them, I believe fundamentally no one knows what's best for you other than you, your wife, your business partners. Like that's how we should build one business at a time, one household at a time, one community at a time, with ownership, with leadership. So I start from that premise. So if I believe that, what if you actually started making some of the financial, let's say financial strategy decisions, not from a quarterback that's helping you manage your money, but
Right.
you taking on that role and little by little building that confidence for you to throw the ball whenever you need to throw the ball. So that's the first part of the model. And I help people, obviously, you and I are specifically within that very large financial services realm. There's all kinds of conversations. We give them a model to think about what we do, which is we live in the part of their balance sheet that we call foundational to protect them and to give them ability to take advantage of opportunity,
Yep.
period. That's what we do. We are not investment advisors, although we think people should invest.
Yep.
We're not budget managers, although people should manage their P&Ls and their budgets and save and spend appropriately and all these things. And we have education in all these areas. But if you and I were to get very concise and clear, like we go a mile deep in this conversation around protection now, protection in the future, protection of the people in your life, protection of your money, and also how do we position people to take down the deal of a lifetime, right?
Yeah.
So
I mean, if you're if you're in a position of protection, the opportunities are out there, and you are not desperate to either take one, and you can be very picky with them.
mhm.
But then you also have that bedrock where underneath your feet is solid. You've got a financial safety net, which is deep and wide, and that really gives you an opportunity to either take risks, start a new business, go and make an investment that might be, a 100 to 1 risk, right? And good chance of losing that money. But if that's money you can afford to lose, and you can afford to lose that, makes those decisions a whole lot clearer, right? And
Mhm.
more, I think, much more likely to impact your bottom line in a way that helps you and your family.
Absolutely, absolutely, and that's a perfect comment there because when we get down to our expertise, which is life insurance, right? If we come across someone that's never had this conversation, never thought about it, never consider it, it's a great place to start a conversation to be thoughtful on the different key thoughts, key variables that they should consider. And the first thing that they're going to say is, "What's life insurance?"
Yeah.
And in a simple way to describe this is, it's a contract, it's a private contract between you, the owner, and the insurance company to protect the life of an insured, okay,
Yep.
to
Yeah.
protect the beneficiaries against the loss of that insured more specifically. So there's three parties to the contract on the side of the person that owns this life insurance contract with the insurance company. And the insurance company is making a promise. As long as you follow the committed requirements, paying premium, for example, on this
Yep.
contract for it to stay in force, we will deliver in our guarantee, in our promise to deliver a death benefit if those are the terms of this contract, right? So
Yeah.
it's a
And
unilateral contract.
most importantly, unilateral contract with companies that have been around for over 100 years,
Right.
sometimes near 150 years, depending on the company you're with and use. Um, and, Dave, at its core, I keep going back to, and I keep screaming this out in the internet when I see these pain in the ass posters talk about how shitty life insurance is as an investment. Well, it's not an investment. It's not an investment at all. It's a transfer of risk, and it's an asset. But don't confuse it as an investment, because it's not, right? And that's where I think our industry both has gotten a black eye because of some of the actors out there, but also it's mud that's slung by the Dave Ramseys and everyone else out there with regards to it. But at its core, we all use insurance, right? We use insurance to protect our cars, our homes,
Yeah.
our jewelry, and you're transferring risk. So you're paying a premium to an insurance company in case bad things happen to your property. Why the hell would you not want to insure the most valuable thing? Your life, your income, your family's income, right? And I know we're going to get into the types and everything, but why would you want to insure it? To me, the whole term versus permanent, why do you want to insure for a set period of time? Don't you want to insure until the end? Where,
Yeah.
yeah. So,
Yeah. Very, very good questions, right? And there may be valid answers in both scenarios, so we're going to explore that. One thing that you said there, which I think is another important distinction to bring here, which is funny, I tell people, hey, think about the relationship you have with your PNC insurance, property and casualty insurance, home insurance, umbrella, um, I don't know,
Hat
car
tip to you,
insurance,
Brian,
right?
if you're listening, and you better be. Yeah.
Think about that. Like all we're doing is protecting ourselves against the possibility of loss of a statistically possible event. The house can burn, I can get rear-ended in the car, right? The moment you go all the way to life insurance, which is why in a lot of our models we put these things, in contrasting positions here. One is external risk you have, life insurance, internal risk to the people in your life at least.
Yep.
Um, the probability of you and I dying, Paul, is 100%, right? So we
Yes.
are dealing with a protection and a risk transfer of a completely different nature. Completely different nature. The probability of your house burning down is a number. I don't know what that number is, depends on where you live, et cetera, right?
Yep.
And we are willing to pay a certain amount of premium, which will be an expense. We're going to pay it, we'll never see it again, in order that if that event happens, the catastrophic loss gets protected with that insurance coverage, right?
Yep.
But the moment I get to the other side of the equation, like I know you and I will be gone. Why would you and I not insure our life to protect our children, to protect our spouses? Because it's something that's certain. It changes the nature of the conversation to me.
Yeah, and I think what medicine is starting to get right is there's a lot of good guys out there, guys and gals, I should say, but educating about the importance of disability, right? So own occupation disability insurance. Um, it's crazy important. I think the stats are nearly over 50%. I think of physicians end up with a short term, at least a short term disability in their career, and a high percentage ends up with a longer term disability. So that's just another form, or you need to have the ability to think about the black swan events, right? And how do you protect against them? Um, we're massive fans of using permanent insurance because A, it protects us, but B, it also provides a foundational asset for us that we can actually, we not only, we send money off to the insurance company, but we get that money back and then some, right? There is actually a positive internal rate of return on the premium we send to insurance companies. That's unlike any other insurance policy. All other insurance policies, that money goes off, you're never going to see it again. Hopefully, you don't have to collect
Yeah.
on the policy. I mean, you don't want your house to burn down, but it's there if you do. But you will never ever see that money again. Permanent insurance? I mean, you and I have policies right now that we can send an email and get a check in the bank, ACH transfer in 3 to 5 business days, right?
Yeah.
On a lien against our policy. So it's incredibly useful, the fact that benefit exists with permanent. But I'm going off track again.
No, no, I love it. It's the conviction that comes across. So what you're saying basically is the following. There are reasons to have all these protections in place when we get to the foundation, the protection of our families, our businesses. There's a reason to have auto and home and umbrella coverage, which you and I both have, by the way.
Yep.
And there's a reason to have also life insurance, with you and I both have. I will speak for me, but I own term insurance. I own whole life insurance. I own whole life insurance on me, my wife, my dad, my parents. There's reasons to this. And what we want to get to the conversation here today at the core is why, for
Yeah.
understanding why. And you may agree or disagree with us, but the point is to understand why we may make some of these choices. So we talked about the fact that life insurance is a contract that provides that protection for the owner on an insured. Is human capital protected with some financial capital, that there's premiums that may be paid for a period of time for the insurance company to provide that coverage, and that it is different in nature from the typical relationship we have with insurance because we are now protecting against an event that is certain, actually the only certainty.
Yep.
We are not in the space of when, excuse me, not in the space of if, but in the space of when it happens, what happens at that point. And we hopefully have the ability to create instant liquidity to protect that family. That's a coverage conversation. So the next part of the conversation becomes, okay, that's great, guys. I understand, okay, but why would I need this, right? And the other framework I want to put in front of this conversation before we get into details is there's two ways to have this conversation, in my opinion, Paul. There's a how much insurance do I need? That's a suitability conversation. That's how states regulate life insurance, right? We
Yep.
need to demonstrate the need for it. But I would argue that there's a conversation that Americans need also to open their minds, suspend their disbelief, and change the relationship they have with their protections, with their ability to be stronger by asking themselves, would I even want insurance? How much would I want? Is a
Right.
different conversation. And
Yeah.
you and I know we're in the want space because we see the benefits beyond a simple suitability space. But this is now demonstration of what education implementation has led us to believe that most Americans, if they truly understand this is not an investment, we're going to repeat this a million times. I apologize in advance. It's not an investment. If they properly understood it, they properly saw the benefits, they properly classify it, they will change the conversation from needing insurance to wanting
Right.
insurance.
It's a kind of a half-ass analogy, but it's much like a house, right? We all need a house or a place to live in, but if you own a house, chances are you want a house that's as nice as possible. A lot of
Yeah.
us want it as big as possible, and we don't treat it. Very few of us should consider your house as an investment, but we do consider it part of our net asset value, right? It's part of our underlying net worth, right? And Kiyosaki has his disagreements on if you've got to send money away, it's not an asset, blah blah blah. But
Mhm.
at the core, it's a value that you are happily paying into.
Yeah.
And I think insurance is the same thing, right? So if you know of the benefits, if you know the end, like you said, it's not an if, it's a when. Um, the bigger the number that is, guess what? The better off your family is and your family's legacy, right?
Yeah.
Kids, right? So that idea of the classic term insurance typically is spend as little for the minimum amount of coverage, right? And people usually go $1 million, and then if you're in your late 30s or 40s, someone says, well, you should really have $2 million. And right, there's the easy calculation of your, amount of years working left times your average income. If you're smart, you should probably put a riser in. Your salary is going to go up by 3 or 4% probably every year, and multiply that number. Well, that to me is like a crazy minimum number because it doesn't account for windfalls. It doesn't account for you might create a crazy side hustle, right, and double your income. And it lacks that imagination of I'm going to grow beyond this, right? I'm going to,
Yeah.
um,
Yeah.
and it's
Yeah.
that small thinking that I think, to your point, people need to break out of it and understand that, create a big insurance home that you want to live in, that your family, because your family is going to live in it after you're gone, right?
Yeah. Yeah. Yeah.
You get to live in it and enjoy the benefits, but ultimately, when you're gone, your kids and your kids' kids are going to be the ones whether or not that house is still standing, depending on the
Yeah.
size of the policy.
Absolutely. It's funny because your house analogy, this is how I present it in conversation. If in the basement of that house you had a machine that makes $100,000 in profit to you every year and it's going to work for the next 20 years, make you $2 million, how much would you insure the machine for? And I have never have anyone say anything
Less
other
than
than
two
$2 million.
million. Right. Yeah.
Okay.
Yeah.
And I asked him, most Americans are like a Ferrari driving down the street with $30,000 of insurance as if they were a Honda Accord. Okay.
Yeah.
And we forget that. It's like we are the most valuable, most productive machine in our households. We are the leaders. We're creating income. Our ability to generate income is the strongest tool to basically acquire abundance for our
Yeah.
family.
I mean,
And yet we dismiss the fact that that is going to have a significant economic value into the future.
yeah. Yeah. I mean, think of your former engineer colleagues back when you worked at
Mhm,
GE.
mhm.
All the physician colleagues I know, we obviously run in circles with nurses and lawyers, and even some guys that are owning like HVAC companies and everything, and their financial future can be fantastically bright, right? And we underestimate what salaries are going to be in 10 years or 15 years. If you're 30, your income more than likely is going to double by the time you're
Yep.
my ass old age of 56. So,
It's
um,
gonna grow for
yeah,
sure.
it's going to grow.
For sure.
It's absolutely going to grow.
Yeah.
At 3% growth, will double in what? Just under 25 years, I think 24
Yeah.
years or so. So, it's a wages are going to go up. Don't shortchange yourself on that.
Yeah. Yeah. I mean, that is an important realization. So again, all those conversations in the pursuit of like, hey, not just think about need, but perhaps there's a reason to have a conversation around wants. And the natural conversation that emerges for me after that, Paul, is, oh, well, in what situations are you using this life insurance? And I'll give you a simplistic version of this, of course, for you to at least order these decisions in your mind. The way we see it is there's probably three fields in your life that you will likely apply life insurance. It's either going to have to do with your financial planning, which is one of our expertise
Yeah.
fields, and we'll probably be talking a lot about that moving forward. You can apply it to your state plan, of course, if you're thinking legacy, if you're thinking state tax protection, if you're thinking, about a large wealth transfer. This
Transfer wealth.
asset class
Absolutely.
has no comparison to any other asset class. And then there's a side of this where the business planning element of this
Yeah.
is really, really important. I'm going to throw to you a fact here that I think is fascinating. The SBA tracks, Paul, the top 10 reasons why businesses go bankrupt in the country.
Yeah.
Reason number one, cash flow, no
Cash flow.
question about it.
Yeah.
Reason 2 through 10, the bottom nine are all human capital. People
Liquidity.
leaving, people
Yeah.
dying, the
Yeah.
wrong asset, the wrong talent. All this human capital piece is the iceberg below a business where business owners are not thinking that there are assets like life insurance that can help them attract, retain, reward the right employees and protect the business against their loss. So
And
huge field.
this is this a point where I know you've spent personally a ton of time researching and using insurance, but all my colleagues out there with medical offices where you've got some key employees you do not want to lose, you've got four partners and don't have a buy-sell agreement. What happens if someone dies? How do you exit their spouse out of the business? All those things. Insurance is a fantastic tool to deal with those and really provide some incredible strategic ways that not only improve your business's bottom line, right? It gives you a return on what you're spending, but it also protects those people, gives them reasons to stay in the business. Yeah, we should almost do a small little mini kind of video seminar of nothing but that, David, because I don't see it talked a lot out there in the various land of insurance podcasts, and it is really an underutilized benefit of permanent insurance.
Yeah. So simple model. Hey, you might have financial planning needs, state planning needs, or business planning needs that may or may not benefit from the use of life insurance. I invite you to educate yourself about the benefits of that. It's a tremendous asset. So that's
And,
another really helpful frame.
and Dave, the other thing that I really love insurance and its ability to actually improve your financial modeling after you retire, right? So
Yeah.
there's mathematical data, right? Wade Pfau's done some fantastic work behind this, and if anybody wants, I feel free to either follow my Twitter feed. I've got several posts on that, but where he shows the use of permanent insurance increases your ability to not only draw a much higher amount of annual value, but it also prevents the dreaded "I've run out of money" scenario, right? So
Yeah.
using insurance improves your retirement cash flow. No ifs, ands, or buts about it.
Well, that's a perfect segue to the next part of the conversation here, because I think this goes down to like what at the end of the day is the role of life insurance in things like financial planning. And if you want a simple definition of this, is to be the foundation, the anchor that brings certainty, that brings guarantees, that brings stability to a portfolio. And what you're talking about is we do this with a lot of our clients, by the way, and we have content and education on this where if you take the bond portion of your portfolio
Yeah.
and if you want to tame that volatility in the bond market and use a proxy or use something that mimics that behavior of an income strategy to anchor your equities or your stock investments, life insurance is one of those areas that most people underutilize. You'll see a lot of executives using this,
Yeah.
but most people underutilize to lower their stress when it comes to volatility by having a second asset completely uncorrelated that you can tap into for income needs and allow your equities to create the growth under a more certain regime. So that's a conversation we'd love to have. And I'm
Yeah.
sure we're going to deep dive into that conversation with some math. We'll pull some calculators here in the future. But okay. Um, let's talk now about, oh, go ahead.
I was going to say, let's do the elephant in the room, right? Where everybody
Yes,
watches. Term versus whole. Why the hell would you ever buy a permanent policy? Term's much cheaper.
I love it.
I'm going to just say this. Term insurance is not cheaper. You are buying a product that the insurance company prices all insurance the same way. They know exactly by law of large numbers how many people are going to die. So when you're 40 years old, if they have 100,000 40-year-old males, they know that roughly 250 of them are going to die that year. They know that payout is going to be, say, $500,000. So they know that that's right around $12 million in payout they're going to have that year. So then they can go and say, if we have 100,000 customers, how much do we have to charge them to make $12 million? And that's $1,200. Now you got to factor in there's discounts, right? Because they're getting money up front and all these other things. But insurance companies go through every single year. If you're 40 years old and you buy a 20-year or a 30-year term policy, they have the calculation for age 40, 41, 42, 43. They add up that calculation and say that number, if you're going from 40 to 60, is say that total number is 65 or $70,000. The insurance company, when you buy a term policy, you're essentially, the insurance company is saying, we're going to loan you $70,000. We're just going to let you pay it out over 30 years. So they tack on whatever percent, typically 3, 4, 5% to that loan, and that's your annual premium. Now, people think it's cheaper because the insurance company, you're not buying insurance if you're 40 and buying a 30-year. It's going to get a little expensive because when you're 70, your mortality starts to creep up. But overall, most of those years, your mortality risk is very low. So your insurance cost is going to be very low. People freak because they look at a permanent insurance cost and they're like, holy shit, it's, 5 times, or 10 times well, that's because in a permanent insurance policy, you're not doing from age 40 to 70, you're doing from age 40 to typically 119 or 120, right? And correct me if I get a little bit of this wrong, but the at that point in time, you're taking that cost of insurance over that entire time. You're going to use it, right? So it's not like term where good chance, right? And what is the stat? 99% plus of all term insurance policies never get tripped, right? So insurance company, that's all premium to them. And they know that,
Yeah.
right? They also know permanent insurance policies, everyone's going to die. So they know that at some point they're going to have to pay you out a sum that has steadily grown. Insurance companies don't give deals. They have been around 150 years because they use law of large numbers, and they use these very smart people, nerds with calculators, actuaries, right? And they know exactly where their balances, where typically the deaths are. And even on crazy years like COVID, yeah, they had increased death benefits, right? Obviously paid out because of COVID, but because of how strong they are as a company, it didn't crush them at all. In fact, some of them did okay, in some manner. So term insurance, your premiums are lower, but it's not because it's cheaper. It's just because you're paying for a smaller house for a short period of time that ultimately you have a 1% chance of utilizing, a 99% chance of not utilizing, right?
Yeah.
And in the end, that's the only benefit you get with term. Either you're dead and your family gets it, or the money's in the vapor. There are no
Yeah.
other uses for term insurance.
Yeah. So I out of the things I'm gonna pull out some of the things you say there to make sure we highlight the important simpler thoughts so people can create a map. But like the contrast between temporary and permanent insurance is that obviously the difference is for a period of time, 10, 20, 30 years, temporary, as the name says, and then permanent is permanent for the rest of your life. the question that I would ask you to begin with is, do you want to transfer that risk temporarily or
Yeah.
permanently? And people have both answers, to be honest with you.
Right.
Hey, I want to transfer this temporarily, permanently. There's no right or wrong answers. The other thing you said that is very, very important is that the insurance industry has no deals. These are not things that, as people accuse insurance industry, oh, they're greedy, they want to make. These products are perfectly priced to reflect risk. As a matter of fact, the trade-off here is only one. Premiums and risk are a trade-off. The more risk they are, the premium will increase. The less risk, the less premium. So when we go all the way to say things are cheaper or things are more expensive, that's a value proposition, right?
Yeah.
I would agree with you. Term insurance has lower premiums. It doesn't make it cheaper. Whole life, all other permanent products may have higher premiums. Doesn't make it cheaper or more expensive. It makes it a reflection of the risk they're transferring and how
Yeah.
they're transferring that risk. So
Yeah.
that's the other thing. And what you said is true. I can tell you, Paul, I talk to people where I know term insurance makes sense. I will be the first one to raise my hand. I
Yeah.
bought life insurance on me because I wanted to cover the gap to my human life value when I didn't have enough cash flow to pay for permanent products.
Yep. Yeah,
It was,
we did the same. You know, when I got married, we bought term, and then when we had our first kiddo, Maddie, bought even bigger term.
yeah,
So term, yeah, and I, I mean, I still have a term policy on one of my permanent insurance policies. So I
yeah,
still got a term rider on one of them. Term insurance, there are no bad products. They're just
yeah.
products,
They're products.
not bad or good, just products.
And we just need education and understanding of what this
Yeah.
service is, right? So to go deeper into this really quick, right? So term
Yeah.
insurance has a duration, it has things and features you should educate yourself, like convertibility. Can you take that temporary product and make it a permanent product by conversion? If you've never heard of that, we'd be happy to educate you about that. But conversion is a really important feature there. And I can tell you, there's a lot of families, there's a lot of 32-year-olds that come to me and say, hey, my income is here. I'm not saving a lot, but I just had my first child. Do you think I should get term insurance? And the answer is absolutely
Yeah.
yes. I cannot dip into a person's cash flow when they are barely saving,
Yeah.
but they need
That,
to transfer that risk of death immediately.
yeah,
So
David.
temporary insurance is a great solution.
Yeah. And that's where, to me, our goal is to talk to them not only about, I mean, budget. Most people know where their budget is, right? We know where we're wasting money on, but it's other things such as, are you talking with the right tax people? Are you talking with the right property and casualty? Is there places where you can suddenly save 500 or $1,000 a month? Then maybe it makes sense. But for that moment,
Yeah,
that next day they need protection. Buses coming the
immediately.
next day, right? So
Yeah,
um,
immediately.
term is fantastic for that, right? And nowadays you can get term off the internet without even a physical exam, right? I mean,
Yeah,
the insurance companies have made it really, really easy, and to me, it's deplorable if any of our colleagues out there have families and they don't at least have a big chunk of term insurance because it maybe is about a half-hour process to get a policy.
yeah, yeah. Depending on the amount you're getting and all that, the
Yeah.
underwriting requirements may be very flexible. But if you don't, think about it. Consider what is holding you back from transferring the risk of you, God forbid, something happening to you and your family or your kids or your wife having to put raising funds on the internet for a
Yeah.
burial or for
No
income in the
problem.
future. So we see this all the time, by the way. I can tell you, I also talk to a lot of sophisticated people, and I talk to a lot of wealthy individuals that may have a very old buy and sell agreement that the first action to be taken before we talk about any permanent products is to quickly do cross insurance on a term insurance policy just to transfer that risk if anything happens to their business partner or
Yeah.
a key employee. So there's people new in the game, there's people very sophisticated that are using this product to temporarily transfer that risk. Nothing wrong, nothing bad with it. It is perfectly priced. Like you said, life insurance in term typically pays less than 2% of the time. That's what they're able to charge those smaller premiums because as they transfer that risk for only 2% of the population,
Yeah.
with the law of large numbers, they're able to cover those death benefits with those premiums. That's the only way they arrive at that. There's very smart people doing those calculations.
Yeah.
If we cross the bridge and now we go to permanent insurance, Paul, now we're having a different conversation. If every
Much
single
different.
person in the pool of insurance that I have will die and they're all paying their premiums, how the heck are we going to come up with the money to pay those death benefits? It's a different proposition.
Yeah.
Okay.
And it means insurance companies kind of are taking that money. They're investing it in probably relatively safe assets, very safe
Yep.
assets. And they also have a horizon, right? They're not worried about next quarter, next month, next year financials. They have probably 30, 50-year time windows on a lot of their investments. I know you've had some conversations with some of the folks at some of the financial companies that we
Yeah.
work with, and yeah, I mean, what do they talk about their investment horizons?
Yeah, it's fascinating, like this companies are in the business of guaranteeing that they're paying a death benefit 50, 60, 70, 80 years in the future. So what they're doing is really matching a portfolio of assets and liabilities to guarantee that the dispersion between those two curves stays as tight as possible, managing risk so they can deliver on the promises they've made year after year.
Yeah.
They've done this for 150 years consecutively, year after year, and they're going to continue to do this because they're probably the best risk managers in the country, to be honest with you.
And Dave, the other thing I think that people don't realize is when most people think of a term insurance policy, they know they're buying $1 million of coverage, and that $1 million is the same in year 2, year 8, year 30. It's always the same. Permanent policies don't work like that, though, right? So while your first year is perhaps $1 million of coverage, by the time it's year 40, year 50, like say you bought it at first permanent insurance policy at age 30 and now you're age 80, you're not at $1 million coverage anymore, are you?
Well, that's a really good distinction. Level coverage will have the premiums level and the coverage level. In permanent insurance, you could have life insurance policies that are only base premium and they will keep the death benefit fixed and the premiums fixed.
Yeah,
But to your point, now they also have the opportunity to have the death benefit and the protection increase over time, which is a benefit that you and I quite a bit enjoy and use.
yeah,
We can talk more about the specifics on how we accomplish that, but that's important because $1 million today, discounted for whatever inflation rate 30 years down the road, may not feel like $1 million. It will not be the same purchasing power of $1 million. So how do we keep coverage to keep pace with inflation and with the growth of our financial life? That's one of the things. How do we create a product that allows us to create that growth? So
yeah.
we will talk more about the details. I want to bifurcate the conversation on permanent insurance for you because I want to give you also one more model here. In permanent insurance, there's typically two categories. Whole life insurance is the category that people have heard the most. There's a lot of unfortunate ideas in the middle class about about whole life insurance, expensive to own, the worst investment of all time. I can tell you, please, if you're going to educate yourself, the first thing, remember what we said multiple times today. It is not an investment. It is equivalent to other protection assets, and it has the features of a savings environment that has safety and liquidity. But it is not an investment. You cannot compare the performance, the qualities, the benefits to anything else because this is the most important part, is created on the foundation of guarantees and certainty. It is certain to protect something that will happen to all of us, Paul.
Yeah,
And in the reverse side of that is a contract between you and the insurance company where the insurance company is saying, as long as you pay your premiums, Paul, I guarantee when you die, not if, but when you die, we will pay a death benefit to your beneficiary. We will guarantee that the growth inside the contract, your cash value, is what we call the equity inside the contract, will grow over time. At some point, it will be equal to the death benefit. That's how they design the curve of growth.
yeah.
But we'll guarantee that regardless to what happens in inflation, taxation, markets, interest rates, we are
Guaranteed
going to
growth.
take on the risk of growing this steadily over time.
Yeah.
And we are going to guarantee that your minimum premiums, the premiums on the policy that keep the policy in place, are always the same now and into the future until the end of this contract. Simple
All
contract.
with a company that's been around forever, that once you're a policy owner, you're actually an owner of the company, right? These are mutual companies. So there are no
Mhm.
stockholders in these companies. They're you, the insured, are owners of the company. That's how you share in the dividends, and your dividends can be used if you want to increase your level of insurance, increase your death benefit, which all have a sort of a positive reinforcing flywheel effect on your policy value.
Absolutely. And because they're not an investment, they're a protection vehicle, they experience a very favorable tax treatment. We're
Yeah.
protecting the insured, we're not investing here. So the policy receives premium after tax, but then it grows tax defer. The death benefit is income tax free. The access to the equity in the contract or the cash value is at a tax-free
I think
basis.
they should call them
So
Roth insurance products, you know?
Yeah, and we definitely don't want to use that name because we don't want to invite any of the regulators on that space
Uh,
here. But yeah,
Hey,
some
Dave,
people
that's
use
where
the
you put that.
expression,
Yeah, yeah,
the rough or the rich.
yeah. Oh,
Imagine a rough that doesn't have any contribution limits, Paul. Nobody's telling you, hey, you can only put
yeah.
this amount
Well,
here.
and you know, the IRS back, I think it was in the 80s, right, where they actually did limit, the amount, right, created the modified endowment contract, right? So there is a limit what you can put into policies based upon your death benefit, and there's ways to mitigate that and everything like that. But these were so good that the IRS realized they needed to put some governors on them because the wealthy were taking advantage of their tax treatment.
Yeah, yeah. 1986 history on tax treatment of life insurance. So yeah, I'm sure we'll deep dive in some of the tax
Yeah.
conversations around life insurance. We should interview
They,
somebody for that.
that would be a good. The other thing is, you know, I always try when I was learning medicine, I would look at people, great doctors that I wanted to be like, right? I looked at them, how they interacted with patients, how they did procedures, how they intubated, how they dropped a line in, right? So you imitation, right? No one, there's nothing new under the sun, right? We're all imitating other things, other people. Um, when you look at permanent insurance, you can look to the airwaves and the people that say it's a horrible investment. It's not an investment. But more importantly, look to companies, look to, corporations, banks, um, individuals who are known to be very wealthy, who are using these products, and it's those people, right? They're using very similar products
Yeah.
for their assets, asset protection, for their creating that foundation, right? And it's not their only asset, nor is it their only strategy, but you got to believe it is part of their foundation.
But we've forgotten that this is embedded in this is an American-based product, American values-based product, Paul. You and I are farmers, and I don't know, 200 years ago, if you die, I stop with capitalism, with specializing in your field, medicine, engineering, right? If you die, our village doesn't have a doctor anymore.
Yeah,
We're all screwed. So what if we transfer that risk not just for your wife and your kids, but for our village to say, hey, if we all pull a little capital, if one of us doesn't happen to wake up, we'll be able to at least create a pool of liquidity that allows the village to protect yourself against the loss of human capital. You extrapolate that to 100 years with sophistication, we're doing the same thing, but we are still operating under very basic principles. It's transfer of risk of the 100% likelihood of somebody passing at some point,
yeah,
and we're just using vehicles that enhance that transfer of risk with other living benefits. So one of them, again, in that permanent category, being whole life insurance. On the opposite side of that, by the way, this product has been around for 150 plus years, right? 200 years or so.
yeah,
It's an old product that has been tested through the Great Depression, right? People access liquidity when banks close through life insurance
yeah.
policies. We've
World
forgotten that,
wars,
yeah,
famines,
wars,
Spanish
famines,
flu,
the great financial crisis, COVID.
COVID. Yeah,
If you go to the FDIC website today and you go into the liabilities and asset statements for major banks and you go to a line item 40, 41, 42, you'll see life insurance cash values in there. And when you realize that banks own over $200 billion of life insurance cash values, you have to stop and wonder what's going on here.
yeah,
Why are the banks some of the largest purchasers of this asset?
yeah,
If you go to the news and you look at the guy that Trump just appointed as the SEC chairman, Atkins, and
yeah.
you realize
He's got
that
a few
in
policies.
his ethics disclosure disclosed 50 plus life insurance policies. This is the top securities regulator in the country.
Yeah,
He in his portfolio has approximately, I guess, 10% of his net worth, $30 million in life insurance cash flow. You have to wonder what's going on. Why is nobody really talking about this? Why are the banks not promoting life insurance as a way for me to store capital, to protect? Nobody's talking about this. So you have to start to realize it's not in the best interest of most corporations that serve those roles in your life to teach you what they do.
Yeah,
They will tell you what to do, but they won't show you what they do themselves.
and they don't sell it, right? So if you don't
Mhm.
sell it, why the hell would you advertise it?
Yeah,
If I'm it's not like I'm standing outside one of our shops advertising the ER of our competitor. Why would I?
yeah,
It's stupid. So,
yeah.
I don't, I guess I don't believe some will go deep into the, black helicopter conspiracy thing. I don't think it's that. I just think it's everybody,
Awareness.
yeah, everybody has their own business, and they should be paying attention and advertising what they think is great about their own business.
Yeah.
Insurance companies, they're, I mean, I think the other way you were going is with universal policies and everything, and it's one of the few things I remember growing up, right? And when E.F. Hutton talks, people listen, right? Which was the creation of the other side of permanent insurance policies, right? Was the
Hmm.
universal side of policies, if I'm remembering right, if I'm remembering my,
Yeah.
yeah,
So universal life, not good or bad. It's just another type of permanent insurance. We'll position it here for you in a second, but you have to imagine that the forces of economic powers are encouraging people to take control of their money and transfer it into other more sexy things that provide more yield. Wall Street is in a campaign to, make people more sophisticated, 401ks, investment, with technology, equities and things like that get accessible to more and more people, right?
yeah.
So universal life is an invention of maybe the 60s, 70s when the revolution of computing came around. And the idea is that they were going to take a product like whole life that is a little more obtuse because all the cash values, death benefit, and premium are inside a black box where they have this internal relationship that is a little harder to understand. And they're going to create a product now that is also permanent, but it's going to separate the product into the coverage part, an investment fund part, or an investment or growth vehicle part, right? The coverage part we call the chassis typically in our conversation. And then we have the growth vehicle here or the engine. And they were going to allow to have flexibility for clients. You can change the death benefit, you can change the premiums, but with that
Lots of
flexibility,
levers.
a lots of levers, right? And computing power and complexity comes the fact that a lot of clients do not have a strong understanding of the consequences of moving levers. A lot of agents
Yeah.
don't have a clear understanding of what that is. So
And let me
ultimately,
guess, you
Paul,
you give me a dial that I can move. If I move it and it goes wrong, whose fault is that?
and to that point, what they did is transfer some of the risk we're transferring to the insurance company in whole life with the guarantees back to the client. So the insurance company had a way to transfer risk back to you with the promise of a potential upside in some of these growth vehicles that are. So you'll hear now today Universal Life, UL. You'll have Variable Universal Life, BUL. You'll hear Second Guarantee, UL. You'll hear the most modern one in the 2000s emerging called the IUL, Index Universal Life.
Yeah,
Paul and I don't think they're bad or good. Paul and I, and I'm going to speak for you, brother, with
yeah.
respect, because I think you and I are very aligned on this. These are products that people unknowingly, likely transfer risk back to them in a protection vehicle, life insurance. They don't know. But in the pursuit or the promise of a higher yield, perhaps they engage with this product. So I would position more not an investment, but more towards the pursuit of growth, which makes it in a different light than whole life. Guarantee security versus the pursuit of a potential growth.
I have talked with a few IUL owners, and
Yeah.
I had one that really knew their stuff, right? Knew the risks,
Mhm.
knew how the caps could move, and um, you know, to those people, wonderful. That is even for me, that's a complicated product. And I really think, if you're looking at that tool to use, you really need to find some good people that are going to
Yeah.
spend some time educating you. And so you really
Yeah.
understand what you're purchasing.
Yeah. I'll tell you for me, and I think this is probably true for you. Like for me, the transfer of risk doesn't align with how I'm thinking about my
No.
financial model.
Yeah.
So it's not a product I would purchase or endorse. I don't sell IULs. I couldn't help anyone sell IUL if I don't buy it myself. But again, nothing wrong or inherently. I have a lot of clients that own it, and the questions we have are similar to the education we have, that they need to position that product properly to set the proper expectations. One more thing I was going to tell you about this is, since we're having a conversation about coverage, let's understand the difference in coverage,
Yeah.
of the nature of the coverage. So, whole life has a guaranteed death benefit when you die, as long as you pay premiums. End of the conversation. Simple enough.
Period.
You pay the premiums. The insurance companies have not denied a death benefit coverage in the future period.
Yep.
Okay. If you go to UL, what we're doing is, again, regardless of that first initial VI, whatever, you have a series of mutual funds, or you have an interest rate with a fixed income strategy, or you have indexation into an index
Yep.
through an option strategy.
Option
You
strategy.
have a growth vehicle on top of a universal life coverage policy, which is every year you're going to have renewable term coverage that renews every year that you get older at a higher price point, because you're older, you're closer to
So
mortality.
it's back to that simple calculation of 1 year term, 100,000 people. What is it going to cost the insurance company? And they
And
will
it's
charge you that price that year.
and you're gonna pay a price at 40, at 41, 42, and over time is going to grow. And as you grow older, your probability of dying becomes
Goes up.
exponential, which makes the cost of it exponential. So the premise here is we need to set up a universal life policy that can overcome the exponential rising of coverage with the growth of whatever vehicle we have. And I tell you, what we see in our practice is a lot of these policies unfortunately tend to lapse at age 70, at age 80, because people either have moved these variables and they didn't understand the consequences. Maybe they underfunded some of these policies. Maybe they increase or decrease at times the coverage, and they've played with the machine without understanding long-term consequences, that the machine breaks.
And talk about when a policy lapses, not only do you lose your benefit, right? You no longer have a death benefit. You lose the premiums, but there's also potential for tax consequences.
It is possible that above your cost basis, you'll trigger, if the contract
Yeah.
has a significant amount of funding, and that's typically not the scenario, because typically these things are lapsing when there's not a lot of funding in it, to be honest. But it's really sad to sit to a conversation with a 72-year-old that says, I thought this was permanent. This is how I was going to protect my husband that is not able to work anymore, or a child, and unfortunately, the only solution is, yeah, this year the premium needs to be 20 something thousand dollars for you, like a significant amount above
Yeah.
what they were paying, which
Yeah.
is the worst time, because they don't have that level of cash flow to keep the policy in
Yeah.
place. So,
Yeah. You
um,
you mentioned it earlier, to me and you. That's just a variable that we don't want to introduce, right? That's
mhm,
not part of our foundational base, where I don't have to worry about that when I'm age 70 or 80 or 90. I know what my insurance costs are going to be, right? And by using some of the tools in my policy, if I want them to be zero, I can have the dividend pay for my premium, right? Where I have no out of pocket. I don't
yeah,
plan on doing that, but um, I know for a fact what my premium is going to be when I'm 85 or 95. And the day before I'm about to die, when I'm getting the morphine drip and the family's all around me saying goodbye, I know that death benefit is active and will be paid off.
yeah,
Yeah,
yeah.
that's
So,
certainty is it's worth a lot. To me, it's worth, if my IRR is, 3 to 5%, on my policy, I'll happily take that over the potential for 7 or 8% on a universal life policy with some sort of chassis bolted on, but introducing all those other variables. It's just not worth it
modeled.
to me. Yeah.
Modeled,
Modeled.
modeled
Yeah.
7%.
Yeah.
So
Yeah.
we'll geek out and talk
Yeah.
more about that,
Awesome.
certainly. But I think we should recap the coverage part of this, because I think we went in a lot of different directions here. So just to
As usual.
clarify, we have temporary and permanent coverage, not cheap, not expensive, perfectly priced for the risk you want to transfer. You may want to transfer that risk temporarily if you are a 32-year-old with a new family and your cash flow doesn't allow to do anything else. You're better off transferring that risk for 10 years and then considering converting into a permanent product. Yes.
Yeah.
If you are doing seller finance of your business in your 50s, and you want to make sure that there's a cash flow recovery if something happens to the buyer of that business, and you don't want to do anything other than temporary coverage, you're better off putting insurance with lower premiums on that buyer that is making cash flow payments over a period of time up to a balloon to transfer the risk of loss.
Yep.
So a lot of applications where there's an appropriate use of temporary insurance, we are owners of this asset class. There's also the idea of permanently transferring the risk that all of us share 100% of the time, which is death. Whether you believe in legacy or not, whether you believe in the fact that there's transfer of energy to bless a cause or people that you love, there may be a need for transferring, the responsibility and risk of debt. A lot of my clients, for example, get permanent coverage up to the level of their debt because I'm one of them. I want my wife, if something happens to me, to take the proceeds of some of this death benefit from my policies and pay some of our mortgages. So the cash flow from our rentals 10x's that day, and she has income to be free with my kids. It's a
Yeah.
strategy, right? So there are reasons to place permanent coverage, and within permanent coverage, there's a side of the world which we call whole life insurance. Very simple, guarantees that there will be a death benefit, level premiums, and a growing cash value for the payment of premiums. Guarantees, okay, certain. And if you want to pursue a different level of upside, potential upside, I should say, you're okay with introducing some more risk, you will look at universal life products that have vehicles of growth, but they have also an exponential cost of insurance growth that may or may not jeopardize the policy in the future, but it'll require more management, more understanding. So based on that, you now can orient yourself to what kind of products to solve one of your three needs: financial planning, business planning, or estate planning. And you'll be able again to transfer risk that is completely different from any other insurance you own, which is your human capital, which is 100% again likely to end at some point.
David, there is a reason why I am a new insurance agent, and you've been around this block a few times. Your expertise, knowledge, and ability to communicate the power of insurance, as well as the break it down into a framework that I think is really important to have, is unparalleled, my friend.
I appreciate that.
I think that's a fantastic way to wrap this episode, and certainly invite people to reach out to us if they want to talk more about this. If you want to argue with us, if you want to talk about your own situation, I think those are meetings that we are eager to have with you.
Yeah, it's all in the service of having stronger families, stronger businesses, stronger communities. So if whether you agree with us or not, that's not the point. The point is to have more honest conversations with truth, less BS. It's our framework, it's our opinion, of course, it's our expertise in some of these areas, but you may have a different opinion regardless. We want your engagement. Paul, a pleasure always to be with you. I will remind everyone, hey, put a comment if you want us to experiment or try a cocktail
Try a new
recipe you
cocktail.
love.
Yeah.
We'd love to do that. I think we've been doing our own, but we'd love some engagement there. Connect with us. In the show notes, we'll put our contact information, but we look forward to seeing you in the next episode. Thank you, brother.
David, we'll see you next week, brother.